Good afternoon, everyone, and welcome. I'm Casey Snyder, and I'm glad to be joined today by Tom Sidoric, now in his senior advisor role, as well as Erica Sullivan, CFP, who all of you know well and who has been assuming a leadership role within our team over the past several years. And on behalf of everyone at Clove Hitch, we want to thank you again for taking the time to join us this afternoon. Now, as we reflect on the past year, one thing has remained consistent, and that is that headlines move quickly, narratives change often, and markets rarely move in straight lines. And our purpose today is the same as it's always been. It's to help you cut through that noise and provide some perspective that's grounded, that's durable, and useful as we plan for our future. So, our conversation this afternoon will follow a familiar structure. We'll begin by looking back at what's unfolded over the past year. From there, we'll attempt to provide some historical context for today's environment. And finally, we'll share the key themes we're focused on as we plan ahead. And as always, we'll provide time at the end for Q&A, and for confidentiality, we ask that people use first names only when asking questions. And assuming compliance approval, fingers crossed, a recording of today's conversation along with the full slide deck will be shared with all attendees and those who couldn't join live, so you can revisit or pass it along. And as always, if there's a friend or a family member who you think may benefit from this perspective, we welcome that you share the replay or future invitations. Now, before we jump in, one brief team update. Chelsea Caulfield, our newest team member who joined us in September, she is officially up and running, and she has already assumed many of our administrative and scheduling responsibilities and will often be the first voice you hear when you call the office. So if you haven't had a chance to do so, please feel free to introduce yourself. She's very much looking forward to getting to know everyone over time. And with that, thanks again for being here and your trust that you place in us, and we look forward to today's conversation. Let's begin. And we begin by looking back, and with that, we begin with diversification. Because of how diversification was the winner of 2025. Now, what this chart displays is how 2025 marked a clear shift in leadership. The assets that dominated recent years, like US mega caps or Bitcoin, suddenly fell back while gold and foreign equities delivered leading returns. And it was one of the clearest examples of leadership broadening we've seen in quite some time. And the broadening of returns is something we've discussed within our last few webinars, and we will discuss throughout the conversation today. Now, why does this matter? Well, it's because diversification may often feel unnecessary, and that feeling usually occurs right before it becomes essential. Because leadership rarely fades gradually, it tends to rotate very quickly and unexpectedly. And for example, in the beginning of 2025, very few investors would have envisioned foreign assets being the top performers, but that is in fact what happened. And it's an example of how markets are cyclical and shifts can occur before anyone sees it coming. So with that, Erica, anything you'd like to add?
Yeah, I think the point is that diversification doesn't try to win every year. It's really designed to keep you participating when leadership rotates, while also reducing the risk of being overly dependent on any market sector style when things change. So it can feel defensive during a year like 2024, and then it may feel more offensive in a year like 2025. And I think that's the beauty of it. It helps smooth the ride while still providing the opportunity for solid long-term growth.
Yeah, and I think, as we showcase here in terms of your foreign equities, suddenly taking the lead, that's where this showed up most pronounced. And we want to highlight this for a minute because not only did foreign equities outperform, but they really did so in dramatic fashion. And this chart illustrates how international equities over here on the right outperformed US equities by the widest margin since 1993. And after a long stretch of US dominance, you can see that by way of the blue bars being below this middle line, global markets reasserted themselves with a vengeance. And even though this is the section where we're looking back, there is something worth noting here within the chart as it relates to themes for the future. Because the last time we witnessed foreign equities deliver consecutive years of outperformance, it was following a period of extremely rich valuations in the US. That was the run-up of the tech bubble. You can see again, international equities lagged US counterparts before the bursting of the tech bubble, which was followed by, again, consecutive years of outperformance in foreign equities. Fast forward, something similar is taking place, or may be taking place, as to where foreign equities have lagged the last several years, and then suddenly they've leapt ahead. So there's the potential for a bit of a repeat performance here, given how expensive US markets are today. Erica, anything else you'd like to add here?
Again, I would just say market leadership rotates, and this is exactly why global diversification helps prepare portfolios for when it does. So this is certainly not a call to abandon US equities nor chase returns abroad. It's simply to highlight that global diversification is about reducing dependence on a single outcome, and I think thereby avoiding the trap of predictions.
Yeah, and when we look back home and turn our attention back to the US market, the concentration that we've been cautioning about really hasn't changed, even despite some of the strong global performance or global results last year. The US market remains highly concentrated in a small number of companies. Now, that said, earnings and returns in 2025 broadened beneath the surface with sectors beyond tech contributing to results, so sectors like industrials, financials, and healthcare. And what you can see here on the left-hand side of the page, that concentration continues where 10 names make up about 40% of the S&P 500. But then on the right, it's evidence of these broadening returns that we're speaking to. So back in 2023, the Magnificent Seven, if you didn't own them, you really didn't keep pace with the S&P because the vast majority of the S&P return was made up by way of these seven companies. A little less extreme in 2024, and then suddenly in 2025, you see that only two of the seven Mag 7 outperformed the S&P 500. And something else to maybe reference is that until recently, the largest 10 companies in the S&P 500 have accounted for about 2/3 of the index's overall earnings growth. That's a really unsustainable figure. And for comparison, during the dot-com bubble, they accounted for only around 1/4. So really big difference. 2/3 is really unsustainable. There's been concern here. And this is why the broadening of returns is so important. And it's also how transitions begin, because concentrations like these rarely unwind overnight. But when you see broader participation, it can signal a healthier and a more resilient market environment. So concentration risk isn't gone. Valuations are still rich, but the opportunity set seems to be expanding. Tom, anything to chime in here?
Well, just the fact that we've talked about market breadth in the past, and I've talked about how market breadth, meaning how the tides rise to float all the boats, is now affecting more segments of the market. The rotation into these other sectors is going to potentially enhance volatility, but we view it as a very healthy development and very healthy for our clients long term.
Yeah, that's well said. And I think as we continue with this looking back theme, we certainly have to comment on volatility last year. Because when we think about 2025, we have to recognize how equity volatility was relatively normal compared to the last few years, even if it didn't feel like it. And this slide places recent market behavior in longer term context. So despite persistent headlines, again, 2025, relatively normal compared to the last maybe 5 years or so. And in the upper left-hand corner, you can see the S&P intra-year declines versus calendar year returns. So calendar year returns are in gray, intra-year declines are in red, and the number to pay attention to here is the average intra-year drawdown is around 14%. So last year we had an intra-year drawdown of 19%. It was concerning at the time for sure, but still the year finished up around 16% in the S&P. Now, this chart only goes back to 1980. So for additional context, if you go back to 1955, The S&P has fallen by 20% or more around every 5 to 6 years. And despite some of these intra-year drawdowns and more extreme drawdowns, the vast majority of years still finished in positive territory. And this goes to show that volatility has always been part of investing. And the media is really good about making the next 15 to 20% downturn feel like it will morph into the next Great Recession. And about once or twice per decade, they do morph into larger events. But that's the nature of markets. And that's why long-term investors have been greatly rewarded. Erica, something to add?
Sure. Just an aside relative to our approach to managing volatility in clients' portfolios. Many of you, I think, are familiar with a tool we incorporated into our practice 7 or 8 years ago now called Nitrogen, formerly Riskalyze, which helps us better understand clients' temperament toward volatility so we can take that into account when it comes to portfolio construction and rebalancing. And I think knowing that is a critical component in helping clients stick with the plan when maybe things don't feel so comfortable, because the fact is we never know when volatility will hit. It's just, until we're really in the middle of it. So it is valuable to be prepared ahead of time. And lastly, just a reminder that volatility is the price of participation when it comes to investing. It's unfortunately unavoidable. So to the extent we can acknowledge our level of emotional response to it, I think the better chance we have of successfully navigating through it.
Yeah, that's well said, Eric. And I mean, thinking about 2025 results, it wasn't without discomfort, but if you were able to maintain that discipline, those results were pretty rewarding. And this next page here provides that example, and it reflects back on 2025 and how we experienced some of those sharp bouts of volatility. And it underscores the importance of discipline, even during what can be challenging periods, and how the best long-term outcomes often require enduring that discomfort. This page also highlights, though, how policy-related announcements can cause sharp and near-term reactions, but that earnings and fundamentals usually prevail. And so this page here shows the downturn that occurred during April of last year. And if we bring ourselves back to Liberation Day and its aftermath, it was an anxious period, and no one knew at the time if it was the beginning of the next global trade war, and few could have envisioned the recovery that followed. It was scary, but markets recovered, and we promise the recovery that ensued, beginning around 6 to 8 weeks later, was not the result of clearly defined sound policy. And this matters because most investment mistakes are behavioral. They're not analytical. And even the most thoughtful plans can be undermined during periods of fear or overconfidence. Erica?
The only thing I would add is that the hardest part of investing isn't knowing what to do or where to go in times of turmoil. It's really just sticking with the discipline and believing in a recovery before you can even see it.
It's very hard to believe in recoveries before you can see it, but markets are forward looking. So, great point. All right, we're going to change gears. We're going to move away from the equity markets into the bond markets. Maybe a less exciting subject matter for some, but bonds are really important. The bond markets are essential. And the title here, we think, says it all, that the bond market has been restored. And that's after more than a decade of near zero yields. Bonds again offer meaningful income. And current yields are among the highest many investors, or we should say some of our younger investors, have experienced in their adult lives. And we witnessed strong results across the board in 2025. And with rates being back within what we would deem a normal range, bonds again provide income to help fund spending goals. They allow for productive rebalancing of allocations, and they reduce investors' reliance on equities and really restore their role as a diversifier. And that's not to say they're risk-free. Interest rates can certainly move. This isn't a call to abandon growth assets, but it certainly reinforces the benefits of diversification. Tom?
Yeah, I'm just excited about where yields are, what the bond market is signaling in terms of stability. and acting as a buffer again against the volatility that can occur in the equity markets. I was much more concerned 2 or 3 years ago, in fact, deeply concerned when rates are pegged around 1 or 2%, because the impact, particularly if it's protracted, the impact of those low rates would have been significant, would have really constrained savings and investment, and would have really damaged certain segments of the economy, particularly the insurance industry and the banking industry.
Yeah, I think the seeing yields where they are is exciting, but it's the stability, it's the combination of yield and stability now that these interest rates are back up into a normal range. And the ability to provide stability is most evident during, periods of duress. And that's what we are trying to convey or show here. Again, 2025 provided a great example of this, but bonds tend to matter most when markets fall, when equity markets fall. And bond holdings can feel pretty boring at times during calm markets. And here we have a list of equity-related events, the dot-com bubble, the great financial crisis, etc., with the dark blue representing the downturn in the S&P, while up above here you can see this is the Bloomberg US Treasury Index. And as concerning as April of last year may have been, and that intra-year drawdown of 19%, bond markets are back to doing what they're meant to do. They deliver income while also playing the role of diversifier. And these real incomes are meaningful in many ways, and we're going to get into that a little bit later. But there is another asset that tends to shine during times of duress, and it was the winner of 2025. We receive a lot of questions on this on a pretty regular basis right now, so no recap would be complete without discussing gold and how gold tends to perform best during periods of stress. When inflation fears rise or currencies weaken or confidence in financial systems are shaken, right? In calmer or growth-oriented environments, gold often treads water or lags. And the 80s and 90s were a great example of that. There's also a great example here where gold underperformed from around 2012 through around 2024. It's when there are geopolitical tensions or world orders shifting, central banks, central governments, they look to gold for stability. And last year, maybe to the surprise of some, it was the emerging market governments that really increased their gold holdings as they aimed to diversify their dollar exposure. So the largest buyers last year in gold that drove quite a bit of this performance was Poland, Kazakhstan, Brazil, and China. So just a little fun fact there for trivia night. But why this matters and why we're referencing gold is gold has historically been viewed as a store of value and a hedge against uncertainty. And its appeal often rises when anxieties are high, not because it compounds wealth, but because it feels protective. And understanding that it can help set realistic expectations. And some of you on this call may own gold directly. And for those of you who may not own it directly, you may actually own it by way of a strategy or two that tends to hold gold to hedge volatility. And I think up until the last few weeks, some investors forgot about the volatility component of gold. And around 2 weeks ago, we were reminded of that when gold and silver fell, 10 and 30% in a matter of one day, marking the metal's worst day since 1980. So this isn't an argument about owning or not owning gold, nor its direction in the near term. We just want to make clear that gold doesn't generate income, it doesn't compound, it doesn't necessarily fund income streams, and it's not supported by a business model. So we just need to understand its role because its return profile has been very different from other productive assets over time. It also costs money to store it, by the way, so its structure is a little bit different than others. Erica, something to add here?
Just one note on the taxation of gold, because it is taxed differently on capital gains than other securities. Many of you may or may not know this, but gold is actually taxed as a collectible. which comes with a tax rate of 28% instead of your standard capital gains rates of, 15 or 20%. So just something to keep in mind as we look to potentially trim gold positions that have really taken off over the past year.
Yeah, and there has been some rebalancing there. We have talked to a few of you, and it is something that we certainly speak with the accounting community about at times as well. So I think our last theme here as we wrap up our looking back section, it is also a subject that we field many questions on. It may be the elephant in the room, and that being policy risk as it pertains to markets. And we know that 2025 was a year of historic headlines. We understand many of you are concerned, but all of history shows how we must separate our holdings from the headlines. And what this chart shows is how markets have continued to compound through political cycles and media noise. And as you can see here, the growth of a dollar in the S&P dating back to 1950 under all presidents in dark blue, under only Democrats in gray, and then only under Republicans in orange. And as you can see, the highest rate of return is for those that were able to remain invested through all political cycles. And if we pulled up a chart that was much busier, which is why we didn't include it, that went all the way back into the late 1920s, it's the same message. Short-term narratives can distract from long-term investment discipline, and markets have a long history of adapting faster than headlines change. And again, think back to Liberation Day and the month that followed and how markets performed in 2025. And that's not to say that policy doesn't matter, but reacting emotionally and allowing political concerns to infiltrate portfolios has been costly over time. Because investment cycles, they outlast political cycles. And as we like to say here, and many of you have likely heard this, capitalism is ruthless. It doesn't care how we feel, for better or worse. And look, at some point, markets will fall in a material manner, and maybe policy will be a catalyst. But so many other variables, like the one Eric is about to discuss, go into prolonged downturns. So no matter what, as we've stated, and we'll state again, we have to separate the headlines from our holdings. Anything to add before we move on?
I just remember a bus ride you and I were on, Casey, in 2016. We had spent the day or the afternoon with former chairman of the Federal Reserve, Paul Volcker, and we didn't exactly know how the election was going to turn out. And we were on a bus coming back, and the election results were coming in, and there was concern and elation and depression and all the above. And we still survived that. And I guess I will bring up this one cover. This is something sitting on your desk, I know, which is The Economist magazine. And the headline for the most recent one is The Dangerous Dollar. Part of the reason that gold and foreign assets have done so well is because the dollar's been in decline. Is it policy? Is it politics? We don't know, but the dollar has been under pressure, and our clients are actually benefiting from that now.
It's and that's something we're getting ready to touch on in just a minute, is the importance of currency shifts. So then with that, we're going to move into important context, and we're going to look to provide what we believe is important context because of how it can be easier to acknowledge change and how change is constant when you understand or appreciate it through a historical lens. So we are going to begin this section with Erica discussing a slide that we have used in nearly every webinar and annual meeting we have had for the better part of the last 4 or 5 years. Erica, take it away.
So we were laughing because I said if I could see you, I would ask for a show of hands to see how many of you are entirely over this slide at this point. But since I can't, we'll just ask you to bear with us one more time, since I think the information within is still very important in the context of both history and potential future returns. So thank you in advance for your patience. But no, this chart, which we've tracked now for several years, really, if you break it down, reflects how markets behave over long periods of time. So you can see this black line kind of down the center that Casey will highlight is the trend line. And it's obvious from this chart that prices don't move in straight lines. They go up, they come down, but eventually the point is they tend to come back to the trend line at some point, and this pattern has repeated across many market environments, as you can see here. So today, valuations in the US are as high as they've ever been. I mean, we're almost off the page at this point. And while this doesn't help us see the future, nor does it tell us that any reversion to trend is imminent, it does help us frame expectations because we know that future returns may look different than what we're used to in the current environment. So what goes up has eventually come down, though we don't know when or how. On the flip side, markets can remain above trend longer than feels reasonable too, and they often do. So again, this is less about prediction and more about setting expectations for the future and I think planning responsibly.
Well said, Erica. And when we turn our attention overseas, though, it's a very different story. And that is, and we bring this page back from prior outlooks because of how important it is for investors to understand. And this slide highlights really the meaningful difference between US and non-US equity markets today. So over here on the left, you can see international price to earnings discount versus the US. The bottom line is the lower this gray line goes, the cheaper or less expensive foreign assets are relative to the US. And coming into 2025, we had never seen foreign assets as cheap relative to the US as they were. And even after the strong year they had, as we just showed right off the bat, they're still historically cheap relative to the US. And then on the right-hand side of the page, you can see difference in dividend yield versus the US. So the S&P yields around 1.4% or so in terms of income. Foreign equities yield around 3%, so about twice the sum. And when you put this together, it's a powerful equation, or I should say, could be a powerful equation. Your starting point is less expensive, your income is higher. For accumulators, this may offer a really powerful compounding combination. Again, cheaper entry points with higher yields. And this aligns with the old adage of buy low. We know it is easier said than done. And then for retirees, this creates an opportunity to fund spending while still participating in long-term growth. Now, this doesn't guarantee outperformance. It doesn't mean that international equities are risk-free. Dividends can change. Currency, to what Tom just mentioned, can fluctuate. And returns may not be smooth. But the point is, we're starting from a far more favorable setup. And we talk about that old adage of buy low, sell high. Much easier said than done because we know how hard it is to trim from winners, to buy into assets that may have lagged. But this comes back to why maintaining discipline is so important. And as we just showed you, leadership can shift very quickly. And to that point, and coming back to what Tom just mentioned, when we invest internationally, currency cycles really start to matter that much more. And this chart illustrates how periods of dollar strength is represented by the white stretches here, and dollar weakness, represented by the gray bars, have historically influenced which regions lead and which lag. Because currency cycles, they don't just affect travel costs, they materially impact investment returns over time. So what we can see here is when the dollar has strengthened during these white stretches, you can see foreign assets tend to underperform. But when the dollar weakens, foreign equities tend to outperform. Now, this is a rolling 3-year annual average return, which is why we do see a bit of a weakening here in the dollar. We don't see the purple above the line yet. That's only because of this being a 3-year rolling average rate of return. If this was looking at just the last 12 to 18 months, the purple would certainly be above. Okay, and so this is, again, when currencies weaken, international assets tend to receive a tailwind. And these cycles, US strengthening cycles, tend to be anywhere from 8 to 10, 8 to 12 years. The last one was 14. Weakening cycles anywhere from sort of 4 to 8. Tom, something you'd like to add
Yeah,
here?
we're seeing this in our clients in our practice. Many of you who have traveled overseas, or even Barb and I have done a little bit of traveling this past year. Trips overseas are not the bargain they were 5 years ago when the dollar was really strong. So that's noticeable and it's impactful. It hasn't impacted our travel yet. But the other area is we have clients that are importing from overseas, importing for their production, for their businesses, goods and services. And many of them are commenting about how the drop in the dollar has impacted their import costs, not just the tariffs, but the actual currency fluctuation. And so far, they're able to manage it, pass along the increase. But long term, a weaker dollar could, in fact, be inflationary.
Yeah, I think this represents the cyclicality of markets. Erica, you touched on, Tom, you just touched on it. I mean, markets, they ebb and flow, and currencies are no different. There is a cyclicality to them, there's a cycle to them. And to what you just mentioned, Tom, though, about inflation, interest rates have undergone a similar shift back towards their mean, back towards their trend line, which is really important to understand because of how it opens up new opportunities. To your point earlier, Tom, about meaningful income streams in the bond market. So this chart reflects nominal and real U.S. Treasury yields dating back to 1958. And after a decade of abnormally low interest rates, rates have moved back in alignment towards their longer term averages. And this represents a meaningful shift from the environment many investors may have become accustomed to over the past decade. In many respects, we are coming out of a lost decade in fixed income. So the blue line here represents the nominal yield. The gray line here represents real yield, yield after you take into account inflation. And what you can see here from is around 2011 through around 2023, real returns were painfully low, either painfully low or negative. And a negative return essentially equates to a tax on savers. But now yields are back and real returns are positive. And this restores choice and it improves future return potential, and it reintroduces income as a meaningful component within portfolios and gives investors a lot more flexibility. Tom, something to add here?
Well, no, just the fact that I think we now are seeing. I mean, this similar to what I said about the equity markets broadening out. This excites me. The fact that real yields and bonds are positive, net of inflation. That's really encouraging, particularly as many of us, the boomers, are approaching retirement or in retirement, and we want income and stable income from our fixed income investments.
Yeah. And a normal rate environment can be especially helpful during periods of volatility, as we just referenced. And we just showcased how intra-year downturns of around 14% are normal. But if we're trying to provide important context, we should probably reference how midterms are messy, and you might want to expect a little bit more of a downward intra-year downturn this year, given that it is a midterm year. So what we show here is how what you can see midterm election cycles, intra-year drawdowns, they tend to be a little bit more extreme. But once elections pass, markets have often refocused on fundamentals rather than the politics. And this matters because we know political uncertainty can dominate headlines and emotions, even when underlying economic or market forces remain intact. And understanding this pattern may help separate the temporary noise from more lasting change. And this doesn't mean that elections don't matter or that outcomes are irrelevant. It means that markets are adaptive systems and they tend to recalibrate faster than narratives do. Again, consider Liberation Day and the downturn and recovery that followed. Markets have historically moved on from political uncertainty faster than investors expect. But even when markets are resilient, it doesn't always feel that way. And that brings us to two very different realities and kind of markets versus Main Street. And this slide highlights the tales of two very different realities. So on the left, we have financial markets, which have remained relatively strong, and household equities as a percentage of financial assets are at an all-time high, reflecting the wealth effect within the upper class. While on the right, consumer sentiment and small business confidence remain at lows, typically associated with recessions and economic downturns. It's a bizarre contrast, and this divergence is often described as the K-shaped economy. And those who own assets tend to feel economic expansions more quickly, while those without them tend to feel higher prices, tighter credit, and rising borrowing costs. And for investors, this helps explain why markets can remain resilient even as economic stress remains very real for a large portion of the population. And in real terms, if you own a home and you have a low mortgage or no mortgage at all, and you own assets, you're probably doing well or very well. And if you don't own a home and don't have assets, your sentiment may be better reflected on the right-hand side of this page. And what we've witnessed is that many of you feel conflicted personally, benefiting from the wealth effect, but also with great concern about the income inequality and the socioeconomic inequality. And why this matters is that markets in the economy don't move in lockstep, right? Markets reflect expectations about the future, while sentiment reflects the lived experience in the present. And that gap can persist longer than feels comfortable. Similar to what Erica mentioned about valuations remaining much higher than what you would normally expect. But socioeconomic inequalities like this only persist for so long before there's some type of mean reversion. And seeing household equities as a percentage of financial assets as high as they are now is a bit of a cautionary sign. But these imbalances are one of the reasons why recessions are helpful from an economic perspective. It rebalances the economy and reduces some of these economic distortions. We talk about this often with the analogy of an oil change. Flush out bad capital, make room for new. And a similar tale is playing out between two other balance sheets, but this time it's households versus the government. And we wanted to highlight this because it's almost an exact opposite situation to the run-up of the great financial crisis, when government balance sheets were healthy and households were indebted in spending in reckless ways. So on the left, we have household balance sheets which remain relatively healthy because of how people locked in those low mortgage rates. And at the same time, government spending over here is at levels typically associated with recessions and the need for economic stimulus. So the US is running a budget deficit of 25%, while net interest expense accounts for 14% of the annual budget, exceeding that of defense spending, which historically has represented somewhat of a tipping point or a dangerous recipe it's hard to come back from. And this matters for two reasons, or why we're sharing this. We're sharing this for two reasons. The first being that the strength of the consumer has allowed the consumer to weather some of this economic uncertainty, and inflation may be better than expected as the consumer continues to expend in ways that support economic growth. And it's one of the reasons the economy maybe hasn't rolled over into recession. The other reason we share this is because strong economic growth may be fueled also by the continued spending of the US government, financed by way of budget deficits and the historic issuing of government debt. And at some point, higher debt and deficits may trigger higher net interest expense, and this can become somewhat of a negative feedback loop. So we're not suggesting that this is imminent. We're not suggesting there's a problem tomorrow, but this is something that we think everybody should be aware of. And so far, the bond market has helped contain some of the rhetoric or policy being floated in DC, and may play a critical role when it comes to reining in some of the spending moving forward. And Tom, why don't you elaborate a little bit more on this one about the bond market's role, because it's a really important element that maybe not a lot of people understand.
I'm often I've often quoted a fellow named James Carville, and there's a new Coca-Cola ad. I'm sorry, it's an old Coca-Cola ad from the Super Bowl circulating when Bill Frist was Senator Bill Frist, and James Carville was the economic advisor to Clinton. And what Carville talked about was the bond market. He wanted to come back as the bond market because then you can control everything. Well, the bond market will, in fact, provide discipline on the United States, whether we like it or not. It will provide discipline. And there'll probably be a lot of noise when the bond market shutters, and it has shuttered a little bit in the last year or two. But if the bond market throws a tantrum, then watch out, and you can watch all the blame games going like this. But it's really the bond market doing its job and providing discipline to the economic system.
We know that's a bit of a high-level topic, but we do think it's one that we wanted to discuss briefly because of its importance and how it may play out at some point in the future. That, though, will conclude our segment of trying to provide some important context as we move into key themes for the future. And no discussion about our future would be even remotely complete if we didn't lead off with discussing AI. It is a transformative technology. It doubles in capacity every 4.6 months, a pace of change that we have never seen before. And what this slide illustrates is that we are still in the early innings of several structural shifts in technology, productivity, and how capital is being deployed. So over here on the left, you can see the percentage of all firms reporting use of AI. We are only at 17%. This was around 10% last year, expected to breach the 20% threshold over the next 6 months or so. And even then, a lot of its usage is sort of the lower hanging fruit, the chatbots, the customer service, the low hanging ops. It has not worked its way into more robust usage. We're seeing the disruption take place in headlines recently. And it's important to know that these transformations are rarely linear. This early excitement, at least historically, often overshoots reality. Then expectations reset and adoption quietly continues. And this pattern is shown up repeatedly across innovation cycles. And it's really important to not confuse some of this uneven progress with failure, because messiness is part of the process. And Erica, why don't you expand a little bit on that?
Yeah, I think that's a really good point, Casey. There's no denying that AI will be transformative in the same way innovations of the past have changed the world. It's just that the path may not be straight. So if we go way back, for example, the railroads literally transformed our ability to move people, goods, and ideas more efficiently, and yet hundreds experienced bankruptcy in the late 19th century. Similar story with the internet and the dot-com bubble. So I think the point is that we should expect uneven progress in the same way we have experienced it alongside other disruptive innovations throughout history. There'll be winners, there'll be losers, but the key here is that we exercise some patience this early in the cycle as we watch these structural changes continue to unfold over time.
Yeah, and Erica, your reference to the dot-com bubble, it does, this feeling kind of brings up this uneven process or progress, and it makes us all think back to the late 90s, early 2000s. And there's been all that talk about, is this the next bubble? And what we want to do here is explain that the excitement looks familiar, but the fundamentals do not. Okay, again, the headlines may feel reminiscent, but when you look at cash flows, you look at balance sheets and profitability, they're all materially stronger. You can see over here on the left, combined market cap, so the price of various companies during that tech bubble compared to earnings. Wide delta here. Over here on the right, you can see the earnings have really kept pace with market cap in a very different manner. So we know it's easy to let some of the historical analogies kind of do too much of the work because of how the narratives may rhyme, but fundamentals rarely repeat, and stronger balance sheets and real earnings change how risk shows up over time. And this doesn't mean that valuations don't matter or that excess can't build. It will. And it doesn't mean that every AI investment or a AI company is a good investment. there will be a lot of misspent capital here. And we know that the story may feel familiar, but the foundation beneath the surface here is very different. And Tom, why don't you expand on that a little bit as someone who experienced professionally the run-up of the tech bubble and then its collapse?
Yeah, you mean this chart that I drag out all the time? Yes.
Yes.
So we've experienced this before. I remember when people said that the internet was going to put us out of business, that people would do all their trading online. Well, certainly they have enhanced their online trading capacity, but our business has never been stronger because people still want a plan that's viable. And I think in this case, we look at AI as something that can. Erica mentioned earlier this tool that we use called Nitrogen, which is very based in AI and been a huge tool in helping our clients understand their true risk tolerance. So when we look at AI or the internet or any transformative technology, we often look at not just the technology itself, but the second derivative. What are the companies? What are the areas of the economy that are going to benefit from this technology, and how can we benefit from those investments? And that's really just starting now.
Well, and that speaks to Tom, the broadening of returns. And to your point, the second derivatives, the third derivatives, this slide shows early signs of participation broadening beyond that narrow group at the top, and how returns are increasingly coming from other sources, even if the index concentration remains high. For compliance reasons, we had to take out a number of individual names within every category, but we are seeing that broadening of returns. We're seeing materials, utilities, industrials begin to benefit as there is a rotation out of technology that's occurring, not just because technology was frothy or that it's expensive, but because, to Tom's point, when you look at how AI is going to assist other sectors and other companies, it's probably pretty profound, but it's going to be a messy process from beginning to end. And so, again, this doesn't mean that concentration risk has disappeared. There's still risk out there. But these transitions tend to be uneven, and that really is the norm. So we're pretty excited about some of this and the broadening of returns. We're seeing it, we've been discussing it, and it is happening as we speak. Tom, something to add here as well?
Well, no, we often refer to the Nifty 50 about, and Erica referenced it earlier about not investing in the rearview mirror. This is proof positive that we can't do that. You have to have a broad, diversified portfolio, and you don't know the companies that are have yet to benefit from AI. And many of them I can name, but then we'd have to have a compliance problem. But I think the change is going to be significant, and I think for the most part, it's going to be very positive.
And when that participation broadens, those outcomes tend to vary more widely. And we bring this slide back from our outlook in early 2025 because of how relevant it is. And what we can see here are that previous cycles of outside leadership for small caps followed technological leaps that impacted society and spawned new business. So, well, in the era of AI is likely no exception. And this likely presents an opportunity, especially for some of our younger savers or for those that have a higher risk profile. And what we can see here is how small companies have often lagged through these innovative stretches, and then they have followed by outperformance. And we brought this up about a year ago because of, again, how small companies have lagged their larger mega cap counterparts, but all of a sudden they are starting to deliver. And it may be a surprise to many that small companies have actually outperformed the S&P by 11% over the last 6 months and around 2% over the last year. And even in headlines recently, right? We think about the last 2 or 3 weeks and how a company that maybe very few people were familiar with, it's not publicly traded so we can reference it, but Anthropic, few were aware of who they were 2 years ago, and it wiped out nearly $1 trillion in market cap about a week ago. So the new companies of tomorrow are being born in some ways. Um, and again, this doesn't mean that, small caps are suddenly going to take over, but there are opportunities out here as this technology begins to ripple through different segments of the marketplace. Erica?
Yeah, that's a good point. I think in continuing with the AI story and thinking about small companies specifically, it's highly plausible that many of the leaders of tomorrow haven't even been born yet. I think a good example from the internet revolution is if you think about Cisco, a company that was one of the original architects of the internet infrastructure, one of these stories at the time. And fast forward, that company eventually gave rise to the Netflixes, the Amazons, and the Googles that dominate the world today. And I should note for compliance purposes, again, sorry that this is not a recommendation to buy or sell any of these companies, have to say it, but it does simply remind us that we are in the very early stages, and some of these smaller companies today could very well be our future market leaders.
Erica, that reminds me of a chart that we had in one of our prior outlooks, how it showed how the top 10 names in the S&P change every 5 to 10 years. And I think it was really hard a year or two ago for many investors to think of how are these top 10 names still not going to be the top 10 names 10 years from now? And I get the sense that the public is starting to kind of scratch their head and go, huh, well, maybe there are some new names that could work their way into these top 10 over time. So it's just the reminder of how leadership changes, market structure evolves. And to Tom's point, I think you mentioned this earlier, but don't invest in the rear view mirror. So we know that AI as a subject is one that we could spend all day long on. We could have a lot of conversations about, and there's a lot of potential scenarios here. So we thought what we'd try to do is try to boil this down to maybe 3 different scenarios and how that may impact returns, especially within the US large cap space. So, courtesy of Vanguard's investment committee and their outlook, they break down the scenarios of AI into three. So we have 3 scenarios, with the first being that AI's transformation is stronger than expected. Earnings growth remains very strong. And with that, it translates to average to above average continued returns within the more expensive category of the market right now. They only assign about a 10% probability for this scenario. The most likely scenario is scenario number 2, where AI emerges as a general purpose technology. Earnings growth moderates some. And with that, because of the really high starting valuations that we see, so do returns. They fall a little bit below their historical averages, but are still respectable. Scenario 3, 30% probability, is where AI disappoints. And there's a lot of misspent capital. The adoption rate is much slower than expected. And again, with that, with really high starting valuations, that translates into more of a lost decade within what's been a very popular segment of the market over the last 10 years. So no one knows what lies ahead collectively when they tally all this up on a probability weighted scale. Ultimately, their forecast is that US large cap returns moderate a bit below average with heightened volatility. And that brings us to their capital market assumptions. We have shown these in the past. They're updated on a regular basis. And the idea here, again, nobody has a crystal ball, but the idea here is to help set expectations in a way that helps people understand how things could change. And we've said future returns may look different from the past. Tom referenced, don't invest in the rearview mirror. Eric has referenced mean reversion, the cyclicality of markets. We've talked about currency cycles. And this all translates when we look at Vanguard's forecast. This is their 10-year forecast, not knowing how we get there, but they look back 10 years from now, and here's what you might be able to expect. And the major takeaways from this are that returns moderate within US markets as a whole, and in particular within some of those large mega cap growth spaces. However, US value, overseas markets, and the bond market as a whole still look attractively priced, especially when you take into account risk-adjusted returns. And we think that's a really important point to make, is that if you can achieve a 4, 5, 6, even 7% maybe return in fixed income, with a third of the volatility of that of the stock market, especially if some of the US markets or areas of the US market moderate, that is a very attractive risk-adjusted return. And it's something that we don't think enough people are appreciating or excited about. We understand it's fixed income, it's not the most thrilling subject, but it's certainly worth highlighting. So, Erica, anything you'd like to add to that?
I think you covered it. I think the bottom line is that, return expectations may have moderated, but opportunity certainly hasn't disappeared. It's definitely out there, and we're doing everything we can from a portfolio perspective to manage the variables within our control so we can account for some of these shifts in the future.
And I want to go back just for a second because if we are, and we're going to touch on this in a minute, but if we are entering into a lower return environment, it means that the planning matters that much more. Income, diversification, tax efficiency, they all play larger roles if markets are going to do a little bit less of the work, and really emphasizes the need for diversification. So just because moderate returns may moderate in some areas, it doesn't mean that there's a pessimistic outlook. It just means that we have to pay more attention to those details, and that's what we do on a regular basis. So we do want to, though, quickly showcase the bond markets again real quick to really pound home how attractive these yields are. This here reflects where current interest rates are across different segments of the bond market, from left to right, lowest risk over here on the left, highest risk over here on the right. And what you can see is that starting yields are pretty much between sort of that 4 and 8% range. Yields that we're excited about, especially if inflation continues to hover around 3% or sub 3%. And this, as we've referenced, it provides kind of some other opportunities in broadening exposure. And many of you will have seen changes in your bond portfolio over the last 4 or 5 years as we have been broadening one's exposure to take advantage of some of these higher yields elsewhere. And there's one area, though, in particular that we do want to showcase here, that being tax-exempt bonds. Because after a decade of near record low yields, when taxable versus tax-exempt decisions really didn't matter much because yields overall were so low, municipal bonds have become more compelling again. And what's so unique is how tax-exempt income can now be attractive even for many middle-income households. Historically, tax-exempt strategies were really reserved for your upper brackets, your 32, 35, 37% brackets, now or higher. But over the course of the past year or so, as rates have changed, even those with an effective tax rate of 16% or higher may benefit from some of these strategies. That's unique. That's very different from where we've been historically, and is why many of you have seen some shifts again within your bond portfolio as we aim to improve net returns and improve overall tax efficiency. And sometimes, even if the net return is similar between a taxable and a tax-exempt strategy, we may move forward with the tax-exempt strategy to diversify one's bond portfolio in general because of evolving risks in the fixed income market. So again, this is something that we've been paying very close attention to. We've made a lot of changes over the last couple of years. And Tom, do you have anything to add to this?
Well, no, it's a continuation of what was started, over 40 years ago, talking about tax efficiency. It's been surprising how tax-exempt bonds have benefited a larger segment of our client base than they used to. And it's good news. It's more money in their pocket. And I think it's testament to how closely we work, and particularly you and Erica work with our accounting community for our clients. It used to be, I joke that early in my career it was 5-10% of my day. It's now probably 40 to 60% of your day is talking to your clients' accountants. And it's about these very issues, making it more efficient for them.
A lot of work regarding tax efficiency for sure, but it's really good work. And that will bring us to the end of our key themes for the future. We're going to summarize this really quickly, and we do have a quick announcement to make here at the end of these key themes for the future. So in summary, as we look back Market leadership broadened with foreign equities taking the lead. Bonds are back to providing meaningful income and stability. And again, discipline, not headlines, did the heavy lifting this year. Important context, elevated valuations matter over time. Global diversification is increasingly important, especially when you consider currency cycles. And that tale of two balance sheets can coexist for longer than many folks expect. While the bond market may provide the ultimate check and balance when it comes to government spending. And key themes for the future, returns may moderate, but we believe the opportunity set is widening. Leadership is broadening, income's back, and innovation remains early stage here. And remember, market transformations are never linear. So patience and diversification have historically been rewarded. And again, if we're entering into a period of lower returns, many of the details we spend considerable time on, variables within our control, will be that much more important. So tax efficiency, tax smart saving strategies, distribution strategies, Roth conversions, asset location, smart charitable decisions and strategies, risk management, rebalancing efforts, etc. They're always important, but when returns moderate, the margin for error does shrink. And lastly, as we continue with the theme of AI, we're excited to share that we are planning to host a webinar on March 26th with Mark Nabby, Equity Investment Director and Portfolio Strategy Manager at Capital Group. He was one of the leaders of their large AI summit at the end of 2025. He knows more about AI than any of us combined, and we're excited about this in the coming weeks. So please stay tuned. An invitation will be coming to you in the next coming weeks as we formalize this. We're excited to be able to spend some time with him as a group. So with that, our bottom line here today, uncertainty isn't a signal to retreat. We know some of you have expressed, I just want to sell everything and go away, but this is the reminder to stay disciplined. And diversification, tax-aware planning, long-term perspective remain the most reliable tools for navigating what comes next. So our next steps, review this update when we send it out, share it as you please. If you'd like to schedule some time with us to revisit any aspects of your plan or portfolio, please let us know. Share this with someone who you think may benefit or is navigating a life event if we can help in any way. And then lastly, reflect. Are we on track? Are we saving? Are we spending in alignment with our goals, with our values? So with that, and on behalf of everyone at Clove Hitch, we want to thank you for being with us this afternoon. We're grateful for your trust, the trust you place in our team, and we cherish that responsibility. And the future will always be uncertain, but it also provides choices. And those choices compound over time, and our role is to help you make the most informed decision possible, and then the next one and the next one with clarity and confidence. So as always, we appreciate you and welcome any questions as they arise. I'm going to flip through disclosures only for compliance reasons, take this off screen share, and address any questions any of you may have within the Q&A feature of the Zoom. Or I think if you raise your hand, we can unmute your line. But remember, first names only, please. Thank you.
Nice job, Casey and Erica. And all of you out there listening, don't forget your favorite Valentine is out there someplace.
All
Good
right.
reminder.
So far, we have no questions. And let's see here. Do not believe I see any hands raised. Anything? Anyone?
Pretty thorough.
All right. Well, if there aren't any questions live, you know you can email us or call us with any questions that you may have, and we always look forward to catching up. So on behalf of everyone here, we really appreciate your time this afternoon. Thank you.